Hey everybody, this video is slightly different than most of the ones I do because I got a chart here. Some people like charts, so let's talk about it because it compares the traditional DST versus the 721 DST because some people really like details. So on the left-hand side over here, we have a bunch of parameters or things that matter to people. Then we have the traditional DST in the middle and the 721 DST. So let's look at the very first one, liquidity, which means access to your money. Traditional DSTs, are they liquid? No. No, in fact, you're in it for 5 to 10 years. 3 years from now, you want your money, you call us up and say, I bought this traditional DST. I want some money out. Sorry, can't get it. 4 years from now, can't get it. 5 years from now, you can't get it. 6 years from now, you can't get it. Maybe 10 years from now, you can't get it. So not liquid at all. Just understand that. The only time you'll have liquidity in a traditional DST is when it goes full cycle. The sponsor unilaterally makes the decision to sell, informs you, and tells you how much money you're going to get. And then you're going to receive that money. You can do another 1031 exchange. If you do another traditional DST, then you're illiquid again for another 5 to 10 years. Or you can take money out and pay taxes on it at that time. So not liquid. 721 DSTs, for the first 3 years, we like to tell people they're not liquid. It's really 2 years, but 3 is a better way of feeling comfortable about it. And any time for the rest of your life that you need access to the money, you can get it with the 721 DST. So which one's better with liquidity? The 721 DST. Holding period. Traditional DSTs, like we said, last 5 to 10 years. The 721 DSTs that go into REITs are perpetual, indefinite. They will last the rest of your life. You don't have to worry about an end date. You don't have to worry about anything like that. Diversification. Well, the traditional DST is typically one property. It could be a self-storage facility. It could be an industrial park. It could be a grocery store. It could be a multifamily, a medical center, could be a number of things, but it's typically one property, which, by the way, carries one property risk, as opposed to a 721 DST, which typically has hundreds of properties that are diversified geographically and by asset class. So again, let's recap. Liquidity, 721 DST is better. Holding period, 721 DST is better. Diversification, 721 DST is better. Cost of entry. Which one's more expensive to get into? Oh gosh, the traditional DST costs between 15 to 20% of equity typically. These are the good ones. There's some bad ones out there that are well over 20, but the good ones are 15 to 20%. 721 DSTs, less than 5% of equity. So 721 DSTs are 4 for 4 versus traditional DSTs in terms of liquidity, holding period, diversification, and cost. How about exiting? Oh, well, traditional DSTs typically have a 3 to 5% exit fee that the sponsor takes for doing such great work over the 5 to 10 year period where they didn't diversify you, charge you a lot to get in, gave you no liquidity. Whereas 721 DSTs, we said 1% redemption fee in here. Most of them are 0, but we always err on the side of caution, so to speak. Do they both get a step up in basis? Yes. So finally, the traditional DST is doing something equal to the 721 DST. However, remember, even though you get the step up in basis, since it's not liquid, you might be waiting for your money for 5 to 8 years, let's say. That could easily happen. So yeah, you get a step up in basis, but is it better? No, because you have no access to your money. Return predictability. Pretty average for traditional DSTs, extremely high for the 721 DSTs, because when you have a portfolio of these high quality income producing assets in a REIT, you can kind of go back 40, 50, 60, 70 years and see what type of returns these asset classes have had over the years. No different than the S&P 500 or, a bond aggregate or any of the classic indices that you see out there. This type of real estate has a classic profile in terms of rate of return that you can count on. So return predictability, very high for the 721 DSTs, not so high for the traditional DST. Annual ongoing costs are both very low. Again, asset class diversification. Traditional DSTs is a single property, no asset class diversification. How about the 721 DST? Of course, it's got asset class diversification. Geographic diversification, traditional DSTs, no. 721 DSTs, yes. Can I sell a percentage interest in my traditional DST? No. 721 DST, yes. Tax reporting, 1099 or grantor's letter for the traditional versus K1. So strike one for the 721 DSTs, because in general, most people look at a K1 and say, it's a little bit more complicated than 1099. So if you are interested in, if your number one priority in the world is ease of tax reporting instead of making a great investment that's predictable and suits most of your needs other than tax reporting. So if you really want tax reporting, you buy the traditional DST. It's easier. You're going to get a 1099 or a grantor's letter. The Big Beautiful Bill, as well as the 2017 Tax Act, had created this thing called the Qualified Business Income Tax Credit for REITs, which gives you 20% tax-free on the income that you receive from the investments. So if a traditional DST pays you $100,000 in income for the year, you'll pay taxes on the 100. If the 100,000 is paid from the 721, you'll only pay taxes on 80,000 of it. Advantage 721 DST. Eligible for Section 731. So this, of course, the traditional DST is not eligible for 731 because it's not a partnership. So the reason, by the way, that these REITs sponsor put together K1 reporting is because it is a partnership. K1 is reporting for operating partnership units. And guess what? Partnerships are eligible for Section 731 in the IRS code, which means, and you'll check this with your accountant, by the way, which means that you'll be able to take money out of your REIT, your cost basis, on a tax-free basis after about 2 years inside the REIT. What else do we have here? We like to look at what's called active tax loss harvesting. Can you do that with a traditional DST? Of course you can't, because they're illiquid. However, with the 721 DST, you can. You can, in fact, have a loss, let's say, on Apple stock or Microsoft or, I don't know, some other investment that you made that you have a loss on, and you can use it to liquidate some of your REIT shares and slowly dwindle your exposure to real estate if that's something you're looking for, okay? So if you go through the list here, it's pretty clear. The 721 DST is liquid after 3 years for the rest of your life. It's designed to last forever. It holds hundreds of properties. You can buy 3 or 4 of these DSTs that convert to REITs or 721 DSTs and own 500, 600, 800 different properties in a portfolio. They're cheap to get into relative to traditional DSTs, a quarter of the price. There's no exit fees, maybe 1%, okay? But again, that's only one of the ones we use. All the other ones have 0 redemption fees. You get a step up in basis, and with the step up in basis that's liquid, you can have, your heirs can have access to the money that day, so to speak. The day you pass away, they have access to the money. Also, in community property trust states, which there's 10 in the United States, your spouse, if you're married, can have access to the money immediately as well upon your passing. They both have low ongoing costs. One has asset class diversification, the other one doesn't. Geographic diversification, the other one doesn't. You can sell your interest in one, the other one you can't. Tax reporting, 721 DST is not as easy for tax reporting. Just want you to know that. Your after-tax income is higher because it's eligible for the QBI under the 721 DST. You have access to your cost basis if you need it. Most people never utilize Section 731, but you can. And you can use it for active tax loss harvesting. So is there any doubt why, if you go back over the last 5 years, the market share of traditional DSTs as a percentage of overall DSTs that have been invested in the United States has dropped dramatically? Market share is now under 50% and dropping. Why? The big companies built a better mousetrap. And everyone sees the advantages and they just go for it. Hopefully, you can see it as well.